So I want to thank you for taking the time to watch this presentation where I'm introducing you to our Betashield strategy. I've got two great guest speakers that I'm very excited for you to meet. But first, let me introduce you to myself and my firm. For those of you who don't know me, I'm Denise Grace, and I own Grace Financial Group and our new venture, Women Empowered by Grace Financial Group. We serve families and individuals who are near or in retirement with a focus on asset preservation and conservative but meaningful growth. The Betashield strategy, it's a market-based investment. However, it has a risk mitigation strategy that really protects the downside. And while we don't believe there's a perfect product, we do believe there is perfect planning. And because we work primarily with those near or in retirement, we believe that asset preservation is key to a successful retirement. And that's why the Betashield strategy fits so perfectly as part of our client's financial plan. Our guest speakers that we have today are Tony Parish, Chief Investment Officer at Alphastar Capital Management, and Brooks Riley, who's Vice President of Advisor Consulting at Alphastar. Now, Alphastar Capital Management is our registered investment advisory firm, and we are investment advisor representatives of Alphastar. So they're our professional money management team, and I would encourage you to go to their website, alphastarcm.com, to learn more about all the amazing men and women that they have on their team. Now, Grace Financial Group, we are your wealth counselors, we are your financial planners. So to use Alphastar, you come through us. So let me introduce you to our two guest speakers, Tony Parish and Brooks Riley. Now, Tony joined Alphastar as Chief Investment Officer in April of 2019, just a little bit over a year ago. And he acts as Chair of the Investment Committee, overseeing Alphastar's investment policies, money manager partnerships, and portfolio model offerings. Now, I'm not going to go through all of the details here, but you can read his bio on the Alphastar website. And Brooks Riley is the Vice President of Advisor Consulting. Brooks has been my go-to guy ever since I joined Alphastar. He's always there to answer my questions and give me great advice. So Brooks and Tony, they've got an incredible presentation for you. So with that, I'm going to turn this over to them.
All right, thanks, Denise. We're honored to be here. We really appreciate you inviting us to be guest speakers on this webinar. Thanks to all the participants and anyone that watches. This is Brooks Riley. I'm coming to you live, quarantined in my living room here in Charlotte, North Carolina. As Denise mentioned, I head up one of our consulting teams over at Alphastar Capital. I'm going to act as your kind of host tonight and let Tony do most of the speaking. So let me just real quick get this disclosure slide up here. Our goal this evening is to provide you with some relevant information and educational content. This is not an offer or a solicitation to purchase any specific securities or investment strategies. As Denise mentioned, you would go through Denise and your investment advisor rep to discuss how some of these strategies might fit well into your financial plan. So a quick overview of some of the topics that we're going to cover. We'll hear from Tony. He's going to give you some of his insight on what's currently happening in the market, what he's paying attention to, what he thinks is important so that you can kind of filter out some of the noise that you hear in the news media and focus on what might be important. We'll talk about some of the fundamentals of wealth management, how they relate to a financial plan and building wealth. And then finally, we'll discuss the Betashield strategy, as Denise mentioned, in more detail, how it works, what it's good for, how it might be a good strategy in your financial plan. So I'll hand it over to Tony to give you his insights on the current market environment.
Great, thanks, Brooks. Thanks, Denise. Brooks, when you said we're going to hear what Tony is looking at, I want to emphasize that it's not just what I am looking at, but what our investment team is looking at. This is not a one-man show. We really use the inputs from several professionals in order to determine our market views. But of course, the biggest driver of the capital markets this year has been the COVID pandemic. unfortunately, this is something we have to talk to. It's popped up. It's impacted all corners of the globe, and it's something that's not going away anytime soon. What you see on your screen is a screenshot from the Johns Hopkins University coronavirus dashboard. It's a map of infections in the world. This is as of the 14th of May, 2020. We see that 4.371 million total confirmed cases of COVID, including 1.390 in the United States. And you could go to this site to see all of the, details if you so choose. The point is the global COVID pandemic took the world by storm. It has had very far and serious consequences in the capital markets, and it really has been the main driver of stock returns, bond returns, and returns across the entire global capital markets this year. Let's go to the next slide, please. On this slide, we see the price of the S&P 500 over a period of time starting at the beginning of the year. And this slide really goes until about the middle of April. But from the middle of April to today, the middle of May, the S&P 500 has moved roughly sideways. It really hasn't had a lot of appreciation or depreciation since this time. We see that starting in February, the S&P really began to weaken. And it began to weaken as the markets began to really discover how serious the economic and global impact of the COVID pandemic would be. It bottomed out around the 23rd of March, and then it staged a very powerful rally since that time, from the 23rd of March until about the middle of April. And as I say, it's gone more or less sideways since then. So we know why the market sold off. It was the sudden realization that COVID could be a significant threat to the capital markets and to the global economy. But why did it bounce back so heavily and so strongly after about the 26th of March? Well, it really comes down to two factors that drove a significant bounce back. And let's go to the next slide, please. The first one really has to do with responses that legislators passed, right? There was a $2.2 trillion CARES Act. There's subsequently been additional relief. These are massive, massive allocations of capital from the public sector to the private sector, including direct payments to households, funding for the Federal Reserve's activities, small business administration loans, emergency funding for states and local governments, as well as funding for testing, expanded unemployment insurance, etc. This was a massive, massive series of operations that have taken place beginning around the third week of March that have really helped to buffer some of the negative economic impact of the COVID pandemic, and the markets responded very favorably to these activities. Let's go to the next slide, please. In addition to the fiscal response from legislators in Washington, there has also been a significant monetary response from the Federal Reserve as well as other central banks around the world. The good news is the Federal Reserve had the 2008 playbook from the financial crisis, and it was able to take several pages from its 2008 playbook and quickly implement them to respond to this crisis. The Fed lowered the target Fed funds rate close to zero, authorized securities purchases, including treasuries, mortgage-backed securities, and subsequently corporate bonds and ETFs. It established loans to support households, employers, financial markets, and state and local governments. And very importantly, it set up currency swaps with other central banks around the world. The way that works is the global trade currency is the US dollar. But if you are in New Zealand, or you're in Australia, or you're in Denmark, or you're someplace in Europe or Japan or elsewhere, Brazil, etc., you may not be able to efficiently trade in your local currency. So what the US Federal Reserve did was set up currency swaps, allowing central banks of other countries to pledge their own currencies as collateral to the Fed, and be able to borrow US dollars to be able to facilitate their global transactions. This was very important, and the Fed's activities really helped to prevent the health crisis from turning into a credit crisis as well. So the short answer to why the markets significantly bounced back from the third week of March was powerful fiscal and monetary responses that were mobilized very quickly and very effectively to help reinstate some confidence in the ongoing functioning of the capital markets. Let's go to the next slide, please. Now, I want to emphasize that we're not out of the woods yet. This is this chart shows the 4-week average jobless claims number. You see it's normally a very kind of boring, low volatility line along the bottom of this chart. And then beginning in at the end of March, it really shot up. And we've had, we've had 7 consecutive weeks now of record-setting jobless claims. A new jobless claims number came out today. It was about 2.9 million new claims over the last week, bringing the total to over 36 million jobless claims since the crisis began. So this is an indication of just how deep and far-reaching the pandemic threat to the economy has been. So while stimulus coming out of the Federal Reserve and Washington legislators has been very strong, I want to emphasize that we are still in a period of significant concern, especially as it relates to the US and global markets. So we've helped to buffer some of the pain, but there's still a lot to be worked through before we can get back to something resembling a healthy economy. Next slide, please.
All right, thanks for that, Tony. Some great information there. Let's dive a little deeper into some more higher level financial planning concepts in kind of the building blocks of building wealth. So I like to position this next one as, what are some of the more important concepts when you approach the topic of building wealth?
Great. So before we dive into the building blocks, I want to say that if you are going to put together a comprehensive financial plan, including a plan for your investment portfolio, you shouldn't be looking to time the markets. In fact, we have a quote here from Roger Ibbotson and Paul Kaplan. This is one of many studies that was done on the topic, but it says that asset allocation explains about 90% of the variability of a fund's returns over time. Stating it differently, if you have multiple years of investing, the majority of the outcome will be determined by your asset allocation, far more so than any other variable that you could use to affect the outcome of your portfolio. What do I mean by asset allocation? I mean, essentially, what is the proportion of your wealth that you're putting in the stock market? What is the proportion of your wealth that you're putting into the bond market? And what is the proportion of your wealth that you're putting into other financial instruments, such as annuities and insurance products? The weighting of those buckets will determine the outcome of your wealth plan, more so than any other variable will determine the outcome of your wealth plan. So I always say it's really not about timing the markets. You shouldn't be trying to time the markets. When do we get in? When do we get out? When do we sell? When do we buy? That kind of activity almost always historically results in below average performance results. And so it's very, very difficult to time the markets correctly. Instead of trying to time the markets, I believe a much better approach, and one that is more sustainable over time, really involves systematic investing. So we'll go into that a little deeper in the next few slides. Let's go to the next slide, please. So these are what I consider to be the 3 main building blocks of wealth. We have on the table, left-hand column, stocks, bonds, and I'm putting down annuities here, but annuities really represent a broad category of insurance products. stocks. What is the purpose of owning stocks? The purpose is to accumulate wealth, to grow your wealth. But it also comes at a cost. And that cost is, if you're invested in the stock market, you bear the risk of losses. Remember that slide that we put up a few minutes ago regarding the price of the S&P 500. If you invest in stocks, you could experience a drawdown. So that risk of losses is a cost of owning stocks. What about bonds? Well, a lot of people think that the purpose of owning bonds is to generate income. And I think that is true historically. However, I don't think that is true in this era of low or zero interest rates, this era that we've been in since the financial crisis of 2008, and we will likely stay in for the foreseeable future. Now, I believe the main purpose of bonds is to be what I call anti-fragile. And that is bonds serve the role of counterbalancing the stock portfolio. So if you have high quality bonds, they tend to move in the opposite direction as stocks. So when stocks go down, your bonds go up. When stocks go up, your bonds go down. It's a little more complicated than that, but essentially you want to own bonds as part of a diversified portfolio. And we'll talk about diversification in a few slides. But you want to own bonds as part of a diversified portfolio in order to lower the overall volatility of your investments. Now, what's the cost of owning bonds? Well, the cost is you're actually receiving a low amount of income by historical standards. So you could get higher income in other types of investments, but the other types of investments may not offer the same diversification properties that bonds offer. So we talked about stocks, we talked about bonds, then there's annuities or insurance products. The purpose of annuities is to provide what I call a defined outcome. Each product will have a different defined outcome. Some generate guaranteed income, some give participation to an underlying index, some provide downside protection. The point is the outcome is defined ahead of time, and these annuities are put into a portfolio to accommodate a specific goal. The cost, however, is twofold. There's an opportunity cost, and what I mean by that is if you invest too much in the insurance product, you may forego the opportunity. You may miss out on the opportunity for other benefits, such as higher appreciation through stocks over time. You also have a liquidity cost. That is, if you have a life event that requires that you liquidate some of your portfolio in order to fund that life event, your ability to liquidate your annuity products may have some limitations. So to summarize with the 3 bullet points on the bottom, I believe the role of bonds is largely misunderstood. They're not, in this era, primarily held for income so much as to provide a volatility lowering experience. I believe stocks plus bonds combined can be very effective in creating a long-term wealth plan. And I believe adding additional tools such as annuities to the stock and bond portfolio collectively will create a better experience for most investors out there. Okay, next slide, please. Brooks, do you want to mention anything before I jump into this?
Yeah. I know you mentioned diversification a second ago and mentioned that we dive a little deeper into it. And I like to preface this next little group of slides just by highlighting my opinion that diversification, and I know you hear it all the time in the investment world, and I think that it is very regularly misunderstood or misused, especially with your individual investors. I like to equate it to kind of the tag of when you're shopping in the supermarket of an organic product. I think most people know it's good for them or understand that it's probably a better product, but they really don't understand what it means on the base level, what it takes to have an organic product. So I just like to preface it with that and kind of let you dive into what does diversification really mean and why is it important?
Sure, great. Yeah, I love that analogy of the organic product. We hear the term, we associate it with it being good, but we may not understand exactly what it means. we can apply that same framework to the concept of diversification. And what I'd like to do is go through a little example on this slide and the next slide to demonstrate and illustrate why diversification is important to the investment portfolio. So this slide is divided into left side and right side, with the left side showing a hypothetical stock investment and the right side showing a hypothetical bond investment. Let's look at the stock investment first. When we have a bull market, as represented by the blue bar, this stock investment goes up 6%. When we have a bear market, as represented by the gold bar, this stock goes down 4%. Okay, earlier I said that stocks and bonds, at least high quality bonds, tend to move in opposite directions of one another. So on the right-hand side, we have this hypothetical bond, which when we have a bull market, represented by the blue bar, the bond goes down 1%. And when we have a bear market in stocks, the bond goes up by 3%. So if you only own stocks, you'll either have positive returns or negative returns, depending on whether it's a bull or bear market. And if you only own bonds, you'll either have negative returns or positive returns, depending on whether it's a bull or bear market. The point is, nobody knows when we're going to have a bull market, when we're going to have a bear market. So why leave your investment results entirely up to chance? Well, you don't have to. If you combine these things and diversify your portfolio, you can achieve some of the benefits and reduce some of the risks. Let's go to the next slide, please. This next slide is the same as the previous slide, except we've added another column on the right-hand side. We have our stock column on the left, our bond column in the middle, and a new column on the right, which is a combination of 40% stocks, 60% bonds. We've blended them together, and we see now if there's a bull market, that combined portfolio is up 2%. And if there's a bear market, the portfolio is up a little bit more than zero. The point is, it's not negative. So as I said in the previous slide, a bull or bear market will determine if you have positive or negative returns if you only own stocks or you only own bonds. But when you combine them and create a diversified portfolio, you can buffer the returns against the downside, i.e. you can reduce losses. Now that does come at a cost. You do forego some of the opportunity of owning stocks. The point is, in diversification, you're accepting a somewhat lower potential return in order to also reduce the amount of losses that you will sustain in your portfolio relative to only owning riskier assets. So hopefully this is a clear example of why diversification can be a very important concept in building wealth over time.
Perfect. Thanks, Tony. So, hypothetically here, we've constructed a well-diversified portfolio. It lines up with the amount of risk and reward that you're looking for. What are some major missteps or mistakes that you see from investors? How might they be avoided?
Yeah, the biggest misstep that we see is panic selling. Investors don't have the appropriate asset allocation for them. And then because they don't have the proper asset allocation, they may incur greater losses, and then they panic and they sell out of their current allocations and they lock in those losses. As we say at the top of this slide, smart asset allocation can protect against losses, but can your clients avoid the panic sell? That's the question to financial advisors out there, and to investors, it's can you avoid the panic sell? So what this chart shows is every one of the drops in the S&P 500 that was greater than 10%. We show it down to the trough level when it bottomed out, and then the recovery from that time. Each one of those gray lines represents one historical trip down and then back up, and the dates of the trough are written on the right-hand side. The blue line shows the average of all of those different events. And we see that in all of those cases, the stock market dropped, or I should say, on average, the stock market dropped to its trough and then recovered to roughly the same level 63 days after the trough relative to where it was 63 days before the trough. So what did bonds do during that time? Well, the dotted line at the bottom shows the returns of the aggregate bond index on average. And we see that bonds pretty much on average just bumped along in a very boring and low volatility way. So creating proper asset allocation, including both stocks and bonds, can help to smooth out that V-shaped line and create something that is a little bit more even, a little less extreme than that extreme V-shape to the downside and the upside. So smart asset allocation or diversification can help to protect against losses. Can be a smart approach, but that's not the only approach. Let's go to the next slide, please. Another approach is what I call systematic investing or systematic hedging. On this slide, we see the dark blue line, and this is the price of the S&P 500. And this was from the time in the fourth quarter of 2018 throughout the first quarter of 2019. That's the blue line. And you see that as the S&P 500 was dropping, we, among our clients, we saw a lot of people panicking and then selling out of their positions at very often at an unfortunate time. They had sustained large losses and then they sold out of their positions and then they missed out on the subsequent bounce back. So imagine if there was a system that would monitor the volatility in the market, monitor when the market is weakening, and then when the market reaches a certain trigger point, this system automatically sells out and stays in cash until the market begins to recover. And when it recovers, this system reinvests that cash back in the market. Well, there are systems such as that, and we'll talk about one of them in a moment. But the reason that we put this slide on the screen is to show a hypothetical example of what the returns would look like if a system had kicked in where that dotted red line is, causing the investor in this system to be out of the market for the most significant portion of the sell-off. Now, it's also out of the market for a significant portion of the recovery, but then gets back in and has an experience that's indicated by the dark dotted line, as opposed to the experience of the solid blue line, which is the experience of the investor who didn't sell out or get back in. So this is a hypothetical example of a system that can remove investors from the market when the market is getting weak and moving investors back into the market when it is recovering.
Perfect. Thanks, Tony. That leads very nicely, as Tony mentioned, into the discussion of one of those type of strategies called Betashield, offered through Alphastar Capital Management. So we very intentionally created and constructed Betashield specifically to touch on a few of the main investment missteps that we see regularly from investors. So we'll dive in here and talk about a few of the key principles within Betashield. So number one is going to be the loss of capital. Simply losing value in your investments. You'll hear us refer to this as drawdown as well. Number two is going to be the lack of upside potential. So this relates to being too conservative in your portfolio and not having the ability to achieve the expected returns when the markets are heading up. And then third, and I think most importantly, as Tony mentioned again before, probably one of the biggest mistakes that we see is just emotional investor behavior. I always like to say, you see in the slide before, when you see the panic sell After the market's already gone down quite a bit, you see a panic sell from people. And then after the market has recovered and everything's looking rosy, you see them, I like to call it the euphoric buy. They buy back in high, they sell out at the bottom or near the bottom, and then they buy back in up more towards the top. I think the news media has a lot to do with this. You see a lot of, and I get questions a lot. I saw a lot with like Bitcoin a year or two ago, and then the marijuana stocks over the last year and a half or so. And they, you see it in the news a lot and you get excited about it and you want to be a part of it. But at that point, it's typically, you've already missed most of the gains. So, everyone wants full participation when the equity markets are going up and no exposure when they're going down. But the unfortunate truth is that is not a realistic investment strategy or possibility. So again, to mention or talk about that a little further, what we can do is implement a strategy that can give you protection against larger, more catastrophic type losses on the downside, like a 2008 financial crisis or what we've seen over the past several months, while providing the opportunity to have a more aggressive asset allocation and participate more fully during those periods of more prolonged uptrends in the market, like the periods of 1991 to 99 or 2002 to 2007, and then again from 2009 to 2019. So these are some of the main principles that we took into consideration when we developed the Betashield investment models. And Tony's going to walk you through some of the details on how this series of strategies is constructed and managed and how they might fit into your portfolio.
Great, thanks, Brooks. And so let's talk about what is Betashield and what is it not. It is a disciplined risk mitigation strategy. It seeks to mitigate large losses in the market. It seeks to capture upside of the market, and it's liquid and transparent. What is it not? It's not a market timing strategy. It's not a guarantee. It's not always hedged or always unhedged. It's not an illiquid black box. And it is not a protection against acute or quick gap risk, such as the giant crash of October 8th, 1987, Black Monday. So that's what it is, and that's what it's not. Let's look at how it works. So Betashield really is 5 strategies, not just one strategy. On the left-hand side, we talk about fundamental, opportunity, and global equity. And then on the right hand, we have US equity and international equity. So each one of these represents an individual portfolio that an investor can choose based on his or her preferences. Just US stocks, just international stocks, just global stocks, or a combination of global stocks and bonds with an 85-25 proportion in opportunity, or global stocks and bonds in a proportion of 65-35 in fundamental. So basically, the way that it works is Betashield has a target maximum loss tolerance. For instance, in the fundamental strategy, if you had $100 invested in the strategy, the target maximum loss would be 12%, bringing it down to $88. Now, is it a guarantee that this strategy will never lose more than 12%? No, it's not a guarantee. But the way that this works is, as the markets begin to weaken and the strategy begins to incur losses, the strategy begins to de-risk and become more conservative, thereby making it less susceptible to further market losses. And so what these strategies do is they set a target maximum loss level, and then as we encounter negative returns in the market, they get more and more conservative in order to reduce the vulnerability to further losses beyond that point. Let's go to the next slide, please. So the components of Betashield are threefold. There's a global asset allocation, there's the loss tolerance, and then there's something that we call the ratcheting function. And we'll go through each of those things in the subsequent slides. Let's go to the next slide, please. So how does the ratcheting function work? Well, essentially, as the portfolios get higher and higher in value, we need to increase the level that would indicate the maximum loss level. So in this example, starting value is $100. We are in a portfolio that has a maximum target drawdown or maximum target loss of negative 15%. So 15% from $100 is $85. However, as that $100 investment goes up to the new value of $105, 15% below that is now $89.25. And then as that value goes up to $110, 15% below that is $93.50. The point is that when the portfolio value increases to certain threshold levels, we ratchet up the loss tolerance so as to readjust it to be in proportion to the new value of the portfolio. Let's go to the next slide, please. Let's talk a little bit about how the risk mitigation works. So on the left-hand side, we have a portfolio that is invested in stocks and bonds, global stocks as well as bonds. And the market is going up as indicated by that, that dark line. The risk mitigation strategy is off. That means, in a rising market, we don't want to be hedged. We don't want to be too conservative. So we let the market portfolio do its thing. However, in the middle of the chart, the stock market peaks and then begins to decline in value. There's higher volatility in the market. We see that there are drawdowns in the portfolio. And as the portfolio hits certain threshold levels, we see that the blue wedge is introduced. And what that signifies is we are selling out of a portion of the market portfolio and keeping that portion in cash. Then if the markets continue to weaken, we increase the cash level. In other words, we sell out of another portion of the portfolio and we're keeping that portion in cash. And then if the markets weaken further, we continue to sell out of a portion of that portfolio so as to hold, by the end of this slide, the majority of the portfolio in cash. 3/4 of this hypothetical portfolio on the bottom right-hand side of this chart is in cash, and only 1/4 is still invested in the market portfolio, and therefore the whole portfolio has a low sensitivity to further losses. Let's go on to the next slide, please. So the previous slide shows how we de-risk the portfolio as markets weaken. Let's talk about how we would re-risk the Betashield portfolio as markets strengthen. So coming onto this slide, we have our portfolio that's 3/4 cash, 1/4 market portfolio, and then we see that the market is starting to increase in value. When the market hits a certain higher threshold, we begin to buy back into the portfolio. In the case of that second donut that you see on the screen, that's 50% cash, 50% market portfolio. Then as the market continues to increase, we reduce the cash level further. In that third example, it's 1/4 cash, 3/4 market portfolio. And then finally, as the market strengthens further, we are investing all of the portfolio cash, and it is fully invested in the market portfolio by the end of the slide. So hopefully that gives you a sense of how Betashield works. We ratchet up as the higher levels are achieved. We will de-risk the portfolio when markets weaken, and they weaken to the point of triggering certain thresholds. And then we re-risk the portfolio as we trigger certain thresholds to the upside, thereby participating in further market rallies. The main thing about Betashield is it is a systematic approach to moving into the market and out of the market based entirely on volatility levels of the market. This is not based on guesswork. It's not based on market timing, based on a gut reaction or headlines or any kind of perception of where things may go in the future. This is a disciplined approach to determining what level of investment is appropriate given the volatility level in the market at any given time. So that wraps up this portion of Betashield.
Perfect. Thanks a lot, Tony, for that description and diving into the Betashield portfolio. So we know that was a lot of information. Hopefully you found it interesting and valuable. We want to leave you with several key takeaways that we feel were kind of the most important that we want to highlight from the presentation. So in the first section there on the markets, the governments are taking action around the world to attempt to get the economies through this unprecedented and difficult time. However, the COVID-19 epidemic and the economic impact of the social distancing, it's going to continue and cause headwinds and uncertainty in the markets for the foreseeable future. In my opinion, personally, I think it's going to be somewhat difficult until we get to the point where we, have a treatment or a vaccine for COVID-19. Along growing your wealth, the importance of having and sticking to a well-crafted and well-maintained financial plan that's customized for your specific goals and needs, we believe is critically important to you meeting your long-term financial needs and having a profitable retirement or whatever your goals are in the future. Everyone knows that these types of events are going to happen, but no one knows when they're going to happen and how severe they might be. So if you wait until after something like this happens, it's too late to plan for it. You can plan ahead of time to, get a desired outcome from events like this. And you can work, again, as Denise mentioned, there's no perfect products out there. You should understand what the desired outcome is from each product. And I would highly encourage you to work with a financial advisor to get a good idea of what's best for your situation. And then Betashield is just one solution that we wanted to highlight. It offers a managed, systematic risk mitigation type of overlay onto a well-diversified portfolio. And again, I would meet with Denise, see your advisor, consult with her to see if it might fit into your financial plan and might be a good solution for you. So we'll wrap it up with that. Denise, I appreciate it. I'll kick it back over to you to wrap it up.
Okay. Thank you so much. That was a lot more information than I was expecting. It was great. I've been in the financial services now for almost 20 years. I've been with other broker dealers, but I feel really blessed to have found Alphastar to partner with. They help me add value to my clients' portfolios. And Betashield is just one strategy, one of a myriad of other investment strategies that they have to offer. So we are your wealth advisors. We specialize in helping clients achieve financial peace of mind. So when you work with us, you work with Brooks and you work with Tony and the whole team at Alphastar. They're my back office. They help me with case design. They make sure that we build the best investment strategy for each individual client. So how do you schedule a meeting with us? Can you go to the next slide, please? Real simple. For more information or to schedule an appointment, you can go to calendly.com, my name, Denise Grace, /30 minutes. That will get you on my calendar for a 30-minute phone call where we can just talk about, what are your concerns? And if we decide to move forward, we can set up another appointment. You can email me at denise@gracefg.net. You can call or text me 248-345-1250. And we are now doing virtual meetings either by phone or by Zoom. And keep in mind that everything, should we decide to move forward, everything can be handled securely online. So please don't hesitate. Don't wait until, we've got a vaccine or whatever they're telling us we need to wait for. We are also able to do appointments one person at a time at the office. So just reach out to me and we'll see what we can set up. For more information on my company, Grace Financial Group, or to learn more about my women's program, Women Empowered by Grace, sign up for a newsletter, etc., you can go to my website, gracefg.net. And please, if you have friends or family that you think could benefit from this information, please forward this webinar on to them. And God bless you. And I look forward to speaking with you real soon.